put on a little bit of that Voyager off of the Discovery album.
Mm-hmm. Okay, I think we are there. Yep. So we're live on Facebook. I will give you the ability to be host.
Thank you so kindly.
Okay, so welcome everyone. This is our second stock options webinar, and your host is Ken Blanks Harrell, and from the Bullish Institute. I'm the library director of the Pontiac Public Library. We sponsored this program, and we hope you enjoy it.
All right. Well, I appreciate the warm intro. I'm gonna throw the camera on real quick just to give a wave and say, hey, everybody out there. But I'm gonna push pause on my video so that there is no bandwidth issues. I believe we're gonna record this, Devin?
Yes, we always do. Yeah.
Okay, so
yeah, it's recording, and we're recording on Facebook Live.
Excellent. So we're going to pick up where we left off. This is the second installment of stock options training. We covered 101, 501. This is be 502. And then the last section would be 503, which would be a month from now. So I just wanted to give a quick recap. If anybody wanted to ask any questions from the first session, feel free to put something in the chat box. If you have any questions, I'm gonna check the chat real quick, and or feel free to unmute your microphone. And then also, this is an AV test, so if you can see my screen, if you can hear my voice clearly, please press the number 1, put it in the chat. So make sure we do the AV check before we get all into it. All right. And Devin, I can handle the stuff on the Zoom side. If you can handle any questions that may come through on the Facebook side. There are no bad questions, no wrong questions. Everyone's encouraged to ask questions and feel free to participate. This is your time.
Okay.
So what I'll do is I'll just jump in and do a very light recap of some of the key elements from last time we got together, and then I'll jump into this week's lesson. Fair enough? All right. So one of the major things to take away were the mechanics of stock options. Just to make sure we do a clean review, stock options are an asset class that are called derivatives, which means their value comes from another place. All right. In the case of stock options, their value comes from or is derived from an underlying asset. That underlying asset is typically a stock or an ETF, which is an exchange traded fund, or even an index fund, something like the SPY that tracks the S&P 500, or the QQQ, which tracks the NASDAQ 100. All right. Okay. These are assets that are derivatives. Their value comes from somewhere else, but essentially a stock option is a contract, which makes it very different from a stock. A stock is a piece of instrument is essentially a piece of ownership of a company. It represents that, and it typically performs how the company performs. If a company does good, usually a stock does good. If a company does bad, usually a stock does bad. And companies can live indefinitely. Walt Disney, for example, ticker symbol DIS, the visionary Walt Disney, the man, has been gone for decades off of the planet. However, his company has still lived on and has grown and reached exponential heights globally and still thrives to this day. But we as people, human beings, have expiration dates where stocks, companies don't necessarily expire. The only way a company can expire is if it goes bankrupt. However, a stock option, just like people, just like fresh produce has an expiration date. Typically, stock options live for anywhere from a couple of weeks to a couple of years. That's about the spread of it. Just like any contract that has an expiration date, a date where it must be executed, it has a strike price, which is an agreed upon price at which the contract will transact. That is the strike price. The premium is the money secured that makes the contract ironclad. The premium is what a buyer of an option pays to a seller. No different than if you buy an insurance policy, you pay a premium, and therefore the person that sold you the policy has taken on a responsibility to provide you coverage because you paid money towards this contract. Exercise is when the buyer of a contract takes advantage of their right. They execute the terms of the contract. They execute to either buy or sell 100 shares of an underlying asset at or before a specific date for a specific price. That is what happens when a buyer of an option contract exercises. And sellers of options contracts are assigned. They are either required to buy or required to sell 100 shares of stock or 100 shares of an ETF or 100 shares of an index fund on or before a specific date at a specific price. All right, because these are contracts. So this is just a quick recap of some of the mechanics of a stock option. Are there any questions before we jump into this, the new lesson? Please feel free to put it in the chat box and or unmute your microphone. But you have to really be comfortable with all of the terms on this screen to be able to trade stock options successfully. If you need to screenshot it and go and look up some of these words at a later time, I encourage you to do so. Y'all all good? Any more questions? None?
No, we can go forward.
All right, let's do it. We're going to jump on into part 2. All right, part 2, stock options. We're going to get into the Greeks. This is going to be great. All right, I hope you guys have pad and pen and are ready to go. And remember, I'm not providing stock market trading advice. This is just for educational, informational purposes only.
Options involve risk and are not suitable for all investors. Options investors may lose the entire amount of their investment in a relatively short period of time. Hello. Today we're going to talk about option trading. Specifically, we're going to talk about the 4 basic strategies that you can do with an option contract. When you think about options, there are 2 different flavors. There are calls and there are puts. Call options allow you to call stock away from somebody. Put options allow you to put stock to somebody. And there are 2 different things that we can do with options. We can buy the option contract and we can sell the option contract. In the options trading world, it's just as easy to sell options as it is to buy them. Now, once I buy an option contract, I'm considered long that contract in my account. And once I sell an option contract, I'm considered short that contract in my account. So if we look at our chart here, we see the 4 simple trades that we can do in the options marketplace. If we buy a call, we have a right to buy the underlying. Obviously, if I'm looking to buy the underlying, I want the marketplace to go up. If I buy a put, I have a right to sell the underlying. If I want the underlying to go down, that's what I would do. I would buy a put. Now, if I'm selling option contracts, I'm going to do the exact opposite forecast. So if I'm selling a call option, I want the marketplace to go down. And if I sell a put option, I want the marketplace to go up. bottom line is, whatever my forecast is for options, there are 4 basic trades that can help me accomplish my goals. So what can I do with the option contracts? Once I have these 4 basic trades in my portfolio, I can craft my position to match any market outlook that I might have. I could be bullish, I could be bearish, I could be neutral, I could want the underlying stock to go to an exact point, I can want the underlying stock to be extremely volatile. No matter what my forecast is, I can take these 4 basic positions and map out a strategy that will make me profitable if my forecast is correct. Well, that's it for today. I look forward to your questions and comments. In the meantime, may all the options you bought finish in the money and all the ones you sold finish out.
All right, so I want to take a quick temperature check. See who was paying attention. See who's paying attention. All right, so they said in the video, if you buy a call, is that being bullish or bearish? If you buy a call, bullish means you think that it's going to go up. Bearish means you think the underlying is going to go down. Put it in the chat or feel free to unmute your microphone. If you buy a call, is that bullish or bearish?
I don't know. See, that's what I want to know.
So we got to talk about it so you can learn. What do you think? If you buy a call means you want, if you buy a call, what does that give you the right to do? Buy or sell 100 shares of the underlying. If you buy a call,
I don't know.
if you buy a call, do you get the right? Are you buying for the right to buy or the right to sell? Calls versus puts. It's only two. Remember, it's only 2 directions. The directions are calls or puts. That's just like driving northbound or southbound on one street. If you're driving on Telegraph and you're going from Pontiac to Detroit, it's only one direction that's going to take you from Pontiac to Detroit on Telegraph. And it's only one direction going to take you from Detroit to Pontiac on Telegraph. But calls and puts are just like driving northbound and southbound on the same street, like Telegraph. It's the same exact speed limit, right? It's 50 on both sides.
So a call is the option to buy.
Yes.
Mm-hmm. Right.
A call, if you buy a call, you are buying the right to purchase 100 shares of an underlying asset, whether that's a stock, an ETF, or index fund, for a specific price on or before a specific date. That is exactly correct. Yes. If you buy a call, you think it's going to go up. That's bullish.
Right. To buy a call.
Mm-hmm. So if you buy a put, even though you bought it, right? You bought it, it means the opposite of a call, though. If you buy a call, that's bullish. That means you're going from Detroit to Pontiac. You're going northbound. If you buy a call, that's going northbound. You want the stock to go up. You want the price to go up. If you buy a call, that's northbound. Right. If you buy a put, that's southbound. You want to go from Pontiac to Detroit. If you buy a put, because you want to put the shares off on somebody else. You don't want them. You think they're going down, so you're going to put them. You want to put them to somebody else. Right. Which means you collect cash in exchange for the stock if you do a put, because you want to put your shares that's in your account off on somebody else. You want to liquidate. You want to sell your share to somebody else. So that's why you would buy a put.
But how does one make money by buying puts?
Great question. So that's what goes into the strike price. Okay, so let's say we're dealing with a stock that costs $50 a share. All right, it costs $50 a share right now. But we're nervous. It's volatile. We think it might be a chance they might not hit earnings. It might be some more competition. Whatever it is, we think it's a possibility the stock may go down. Okay, So if we buy a put, let's say we buy a put for a strike price of $45. It's 50 today. We bought a put for 45. What does that mean? That means if it bottoms out, we can sell it to somebody else for 45. We could put it on somebody else. 100 shares. 100 shares of a $45 stock, that's $4,500. That's real money. Okay, so we bought a put. We might have paid $200 for the right to put our 100 shares on somebody else. Now, if the stock starts tanking, let's say it falls all the way down to 40. It done fell from 50 to 40. Well, now our $45 put is even more attractive because the stock done started to tank. It done fell from 50 all the way down to 40. We have a contract in our hands that says we can put 100 shares of this stock on somebody else for $45. If the price today is 40, then our contract is already worth at least $500 of intrinsic value per contract, because our contract is $5 higher than the current market price.
Right.
At the time we bought it, it was $5 lower than the market. But now over time, whether it was over a couple of weeks or a couple of months, that stock then started dropping. So with every dollar it go down, our contract is more valuable because we have a contract that can make you whole at $45 a share. So for somebody who got in at 50 and it tanked down to 20, they would have like, oh my God, I lost my shirt. I lost $30 a share. Well, hey, I got this contract over here for 45. I can make it so you only take a 10% haircut, right? You only drop from 50 to 45, but you got to buy it off of me. I need some money for that. And that's how you profit, because you flip your contract to somebody else.
But who is the somebody else? I mean, is
The
it
market, the options market, the OCC. Remember, since 1973, there's
Oh, that's cool.
the Options
So what
Clearing
is this?
Corporation. Huh?
Minecraft spider.
What happened? But that's good. Any more questions on that part? All right, so because a lot of y'all requested the Robinhood thing, do you have the app? You want to we could go with Yahoo Finance as well. So either app is fine, whether it's Yahoo Finance or Robinhood.
We can look at Robinhood. I have Robinhood, even though I don't use it much after all that GameStop stuff.
Did you buy the GameStop? Did you get caught in that? Did you get caught up in the mix?
No, I just, I thought it was philosophically kind of underhanded. Maybe you could explain that whole GameStop as a.
You said you
as a-
thought it was philosophically underhanded. No, I ain't tripping. They're not the only ones who stopped the party, though. You know what I mean? Like other companies had to do that. Second. I had to let a couple people in real quick. I didn't realize there was a waiting room thing on here, so let me change.
Oh yes, I usually disable the waiting room before I hand off the host. Sorry about that.
It's all good. We in here. We gonna make it happen. And let me see. So let me switch the host again to this my cell phone real quick. And so we'll go through a Robinhood, like an options chain. I'll charge this battery. All right, so we're gonna go to the Robinhood app real quick. So give me a company that a ticker that y'all want to look at, and we'll pull up their options. Somebody give me a ticker. Nobody? All right, so look, interesting enough. So I log into Robinhood. Okay, thank you, Stephanie. We'll take a look at Alibaba. But notice here, my little Robinhood box, it says your PFE calls expired out of the money. PFE is Pfizer. I owned, if you look at the top in the gray part, it says PFE $39 call, 3/19 expiration. 3/19 was yesterday. So I had $39 strike price on Pfizer, and those calls expired yesterday, worthless. All right, they were out of the money. I no longer have the option to buy 200 shares of Pfizer for $39 a piece. All right, so I can click here to say view the expiration. So this is what it was. At the time of expiration, Pfizer was only $35.53. I own 2 contracts. So because Pfizer was not at least $39, which was the strike price I bought, I lost the money, right? I believe I paid $720 for those 2 contracts. So I lost $720 on Pfizer. So I'd rather show you some losses as well as some wins, but there's nothing wrong with showing you that you can, like they say on the thing, you can lose money in a relatively short amount of time. But it's not about did you win every single trade. It's about what's your overall winning. You know what I mean? So like over the year, this particular account is up over 130%. So, overall, I know how to win, but sometimes you lose. And I thought that the vaccine was going to work and all that kind of stuff. But if I had a paid out of pocket, look at the thing right there. I bought the right to buy 200 shares of Pfizer at $39. If I had to actually spent $200 per share on the Pfizer at $39, okay, I would have had to come out of pocket $7,800 of cash instead of $720. So I lost the whole $720, but right now Pfizer was what? 30. Well, at the time of expiration, it was $35.53. I don't know what it is right now. Let's see. What is it right now? $35.51. So I would have lost, $3.50 a share times 200 shares. So basically about the same. I would have lost about the same. But anyway, in this point, I'd rather it came out of pocket. If I was going to lose about the same amount of money, I'd have rather lost the $700 than be chipping away at 7,000. So let's look at some calls. I'm trying to see if I bought anything. So here's a buy. I don't know where I bought AT&T. Calls a $28 call. I got 3 contracts on that. I paid $170 for them a long time ago. It's worth $184 now. My break-even price is $29.70. It expires on April 16th, which is a Friday, because all options expire on Friday. All right, my equity is $552. That's what it's worth. It's worth, these 3 contracts today are worth $552. The total return, I'm only up 8%, right? They're worth $42 more than I actually paid for them. If I scroll all the way down, you can see the history. I paid $510 for them back in October. I thought the 5G was gonna do something. I was betting on the 5G. I'm like, I know this 5G gonna blow. 5, man, it ain't did jack. I'm only up. I mean, look at this, $42. I done jammed up $500 since October, November, December, January, February, March. Right, we 5 months in. So for me, I don't know about tying up $500 for 5 months, only make $42, but I'm not losing $42. You know what I mean? But the thing is, this is showing you the real. Like some stuff be good, some stuff be bad. Some, some be slow rollers, but you see it here. I bought 3 contracts for $1.70 a piece, but everything is times 100 when you do options. All right. And I did that back in October 22nd. This contract and this whole game is over on April 16th. So I either can exercise it, which means I would pay $28 times 100 shares. So for every contract that I want to close out, I would pay $2,800 because that's the strike price. And that gives me the right to buy 100 shares of AT&T for 28 a share. Now, I'm not obligated to buy all 300 shares. I could buy 100 shares and close out one contract with cash and exercise. So you see this red button here, I could exercise, and I hit exercise and it asks. Exercise the contracts, exercise your options contracts to buy the underlying stock, ETF, strike price, it continue. And it says, why are you exercising your $28 calls that expire on April 16th? I can say I'm covering an early assignment, right? The short leg of my spread was assigned before the expiration date, right? That's if you was out there swimming naked. Not enough liquidity or spread is too wide. There isn't enough market interest to sell this contract, or there's a large difference between the bid and the ask prices, or buying stocks. I want to buy the underlying stock or ETF, right? They want to know, why are you exercising? So you can't just goof off and accidentally hit the button and put yourself on the hook to spend $2,800 per contract, right? Because that's 3 contracts. That's almost $9,000. And you would be pretty much expected to pay it if this is what you're saying you want to do. So know that as a buyer, you have options, no pun intended. You have rights. You don't have to only obligate yourself to buying it, right? You can flip it out to somebody else in the open market, or you can exercise it, which means you're going to buy the underlying and complete the transaction. Okay. Or you can do nothing. You can let it expire. Worthless. You're not obligated to do anything because you bought. If you buy, you are not obligated to complete the transaction. You have an option to complete the transaction. And so time is typically what you want on your side. All right. Because you can always sell that contract to somebody else because it still has a time value. Remember, there's intrinsic value and extrinsic value to every options contract. All right. So those are the things I could do with AT&T. So I put $510 out there back in October. Now this 510 is worth $552. I still have roughly a month to go. If it keeps going up, I'm going to make more money. If it goes down, I'm going to lose money. Right? Right now, I'm above the break even, right? 9 cents I'm to the good. If you look in the lower left, the current price of AT&T is $29.79. If you look up, it says the break even price of T, which is the ticker symbol, is $29.70. So this contract is 9 cents in the money already. Is 9 cents past the break even. If you look down here, you see volume 659, all right, and you'll see open interest of 4,401. That means it's a market for this contract. People are interested in it. I'm not in the illiquid contract, so I'm not going to be left holding a trick bag because there's thousands of open interest and hundreds of volume. That means I can get off of it. Now, implied volatility means this should be smooth sailing. The average implied volatility is about 20-30%. When you see stuff in the hundreds, that's when it's shaky water. All right. And it's going to be a little riskier. Now, of 18% is like, because AT&T is a pretty flat trading stock. It's very predictable. Today, a bulk of our conversation is going to be on the Greeks. All right. Before I jump into Greeks, though, last part over stats, you see the first thing says bid, and then you see ask. Bid means someone's bidding or willing to pay $1.77 per contract for 708 contracts of AT&T. The ask is people want $1.91 per contract times 21 contracts. All right. So the bid, wherever the higher amount of the money is at, is where the mark tends to be. The mark is the average. So that's the price right now. If you wanted to transact, it would transact at the mark, because that's considered the medium, the happy medium between the ask or what the sellers want for it. That's the ask. What sellers want is called the ask. What buyers want to pay is called the bid. So they got to meet in the middle, because this is an open marketplace. So the mark is where basically the OCC, the Options Clearing Corporation, the market makers are saying this is where it's going to shake out to be at. All right. So people are offering 177. People want $1.91. The mark, we're going to meet halfway and call it $1.84. So that's what they saying this contract is worth. Now it's up to us how much you buy or sell for, because you do a limit buy. All right, but this is showing you what this all means. So you know bid, you know ask, you know mark. Previous close, that was yesterday. Yesterday, this contract was worth more money. Contracts typically go down in value every single day due to something called time decay. Because remember, all options expire. So the closer they get to expiration, the more time decay works against you. If you buy options, it's a race against time. If you sell options, time is on your side. So it's always important. Remember, they say only 4 things you can do. Is 2 sides of a transaction. You either a buyer or a seller. That's the only 2 sides in the contract. You either buying the contract or you selling the contract. And now, though, if you know the 2 sides, it's only 2 directions. You can go on Telegraph, northbound or southbound. So it's either calls or puts. That's it. It's only 4 things going on. You either buying something or you selling something. And it's either a call or it's a put. If it's a call, you going from Detroit to Pontiac, and you want to go northbound, you want the stock price to go up. And if it's puts, you going from Pontiac to Detroit and it's going southbound, and you want the price to go down. That's it. Everything else is overthinking it. 2 sides, buying or selling, 2 directions, calls or puts. Got it? We should have all this stuff now down to a pack. And now we can get into the Greeks. The Greeks is talking about basically extrinsic value. Intrinsic value is saying your strike price is 45 on a call and the market price is 50, then that contract is $5 in the money. If it was a put, and then it would be the total opposite. If it was a put and the market price is 45 and your strike price is 50, then that contract is $5 in the money. All right, because in puts, you want the strike price to be higher than the stock price. And on calls, you want the strike price to be lower than the stock price. That's how it works. All right. Now, what intrinsic value is this is what the premium is made of. You paying for something extra. That's why it's called extrinsic value. You pay extra money above and beyond the intrinsic value. What you paying for, that's the Greeks. All right, so in this case, delta, if you look at this Greek here, delta on this contract is 0.89. Then that means for the very first $1 per share that this stock moves up or down, the underlying asset that goes up or down, then that will have an 89 cents per share impact on the premium of this options contract. So if AT&T goes from $29.79 up to $30.79, then that means that these premiums will go up by 89 cents for that first $1 move. So right now is at $1.84. It'll be worth $1.84 plus 89 cents just for that $1 move if it go up before April the 16th, because it expires then. All right, so that's delta. Delta is the dollars. That's the first $1 move up or down. Then you got gamma. Gamma works in conjunction with delta after the second $1 move up or down. So if it go up by $2 and now AT&T go from $29.79 and now it's $31.79, then that first $1 move would be just the delta. It'll go, the premium go about 89 cents. But that second move will be delta plus the gamma. So it'll go up 89 cents plus the 12 cents for that next dollar move up or down. So delta and gamma work hand in hand about price movement, because the biggest impact to the price of a premium on an option is the price of the underlying stock or ETF or the volatility. So price movement and volatility is what moves the needle the most. All right. So that's what moves the needle the most. If you see theta is negative, right? Because I'm against time. Time is theta. Theta is the Greek that represents time. And it works against you. So this means I lose 0.005 percent of the money every day that we get closer to expiration. Vega, even though Vega isn't a real Greek letter, Vega, the letter V, is the representation of volatility. All right, Vega. So that means that is the impact of the dollars to the implied volatility. So you see that 18.31%, that's the Vega. That's basically what that represents. And then rho represents the impact of interest rates. All right. So we know we've had a very negative to no interest rate type of situation going on in America lately. They just had the Fed meeting. You had Jerome Powell, the Fed chair, who was saying that they're probably not going to move interest rates for another 2 years and keep them flat. Okay. So interest rates, or the Greek of rho, probably have a very low impact on the overall premium pricing of options. But you have to understand the Greeks, there's 5 of them. 4 of them are the most important. It's like A, E, I, O, U, and sometimes Y. So it's like delta, gamma, theta, vega, and sometimes rho. But you have to know them because it'll help you have precision with making your decisions on what strike price to get. All right. And a little a cheat code I can give you is delta at a glance. If you see delta, consider that to represent what's the probability that this contract will expire in the money. So at a glance, if you see that delta that you just saw there on AT&T, this particular options contract I have, that 0.89 basically means there's a 89% chance that this contract is going to expire in the money, which means that it's an 89% chance at a glance that I won't lose. I try to be a little more conservative and not take that for just etched in stone. And I'll try to say, well, even if I took 5% off of the number I see for delta, how do I feel about my probability? In this case, it'll still be 84% likely I'm going to win on this contract. So I'm going to ride it out. A sweet spot is to look for deltas between 0.72 and 0.85 if you're buying at the time you're buying, because then you're not going to be overpaying for that probability of profitability. All right. So that's the little cheat code I'm going to give you there. And I'm going to get out of this. I'm going to go back to the lesson and switch to the other computer. Hopefully that was of some value to you folks. If you have any questions, feel free to put them in the chat and or unmute your microphone. We will look up Alibaba as well, but I need to get back on track with the lesson. But if there are any questions, all right. So we're going to go ahead and keep it moving, and I'll bring Alibaba up as the next example. Wanted to show some stuff there. Let's go with meeting the Greeks. All right, let's go with meeting the Greeks. So again, we spoke about it just a moment ago. Gamma, delta, theta, vega, and sometimes rho. Gamma and delta represent price movements. Theta represents time decay. And vega represents volatility. And rho is interest rates. Here's a screen worth screenshotting. May want to take a picture of this. Just giving you, the cheat code. All right, so take a screenshot of that. And I got a video for you This is going to help break down how the pricing works on the Greeks. All right. But again, delta, first dollar movement, gamma, second dollar movement, theta, time decay, vega, volatility, rho, interest rates. Second, I already took y'all through that part. So let's go to this video real quick. And then I'll go back and we'll look at a couple other tickers, including Alibaba.
If you dig deep down into your high school memories, you can probably uncover some facts about Greek mythology. Like Zeus, the ruler of Olympus and all the gods, Hades, lord of the underworld, and all those other guys in between. Well, those memories aren't so clear anymore, but don't worry, today we'll focus on a different group of Greeks, the options Greeks. Like the ancient gods, these Greeks oversee certain domains, including price, time, and implied volatility. The Greeks are an important part of options trading, as they tell you how changes in certain factors may impact an options price. So let's get to know them. We'll start with delta. Like Zeus, delta is the rule over all the other options Greeks, as it often has the biggest impact on an option's value. Delta's domain is price. It identifies how much the option's premium may change if the underlying price changes $1. This means that an option with a delta of 0.40 would be expected to increase by 40 cents if the underlying rose $1. Delta has another important use as well. Some traders might use it to estimate an option's probability of expiring the money. For example, an option with a delta of 0.40 can also be interpreted as having a 40% chance of expiring in the money. The lower the delta, the lower the odds that the option will expire in the money. One important thing to note about delta is that it doesn't have a constant rate of change. It grows as an option moves further in the money and shrinks as it moves further out of the money. To understand how this works, let's look at the next Greek, gamma. Gamma is delta's Hermes, his right-hand man in the price domain. Gamma measures delta's expected rate of change. If an option has a delta of 0.40 and a gamma of 0.05, the premium will be expected to change 40 cents with the first dollar move in the underlying. Then, to figure out the impact of the next dollar move, simply add delta and gamma together to find the new delta, 0.45. Let's move on to theta, the Greek of time decay. Theta estimates how much value slips away from an option with each passing day. If an option has a theta of negative 0.04, it would be expected to lose 4 cents of value every day. Remember, time decay works against buyers and for sellers. Finally, there's vega, whose domain is implied volatility. Vega estimates how much the premium may change with each 1 percentage point change in implied volatility. If an option has a vega of 0.03 and implied volatility decreases 1 percentage point, the premium will be expected to drop 3 cents. There are a lot of factors that could cause a spike in implied volatility. Earning announcements, political conditions, and even weather. Depending on the strategy you choose, a spike in volatility could be a blessing, a curse, or have a very small impact. And the further out an option's expiration is, the higher its vega will be. In other words, options with longer expiration may react more to a change in volatility. Now, let's talk about the little brother of the options Greeks, rho. Rho identifies how much an option's premium may move if interest rates change. Because rates change slowly, they have a smaller impact on options trading. Like all little siblings, though, rho is often left out of the discussion about Greeks. Nonetheless, rho is still part of the family, so he's worth mentioning here. Now, let's pull our Greek council together and look at how they can be used to analyze the sensitivities of a single option. To set the stage, let's say your options premium is $1.30 and your option has a delta of 0.35, a gamma of 0.06, theta of 0.02, and vega of 0.07. Today, price moves from $45 to $46, and the premium increases 35 cents to a $1.65. Because a day has passed, the premium decreases 2 cents due to theta. Tomorrow, price moves from $46 to $47. The premium increases 41 cents to $2.04. This is delta plus gamma. Also, another day gone by means another day of time decay and another 2 cents down the drain. Implied volatility rises 1 percentage point, increasing the premium by 7 cents to $2.09. Putting all these factors together shows how a relatively small change in the underlying can lead to a pretty significant change in the options premium. The option Greeks are a helpful crew to know. They help you understand the impact various factors can have on options trades. You'll get to know them very well as you continue your options education.
All right. So what I like to do is then we go back to the Robin Hood. Go back to the Robin Hood, and I think we should open up Alibaba, and we'll take a look at that together and see what the options chain shows us. We need to look at that. Let me see. How do I close this? All right. Change the hosting. Boom. All right. So going ahead, and you can, to follow along, we'll open up Alibaba, and the Robinhood. So we go to the box, type in Baba. Bam. So Alibaba is $240 a share. All right. So first thing I'm gonna do, because it's gonna default on the 1-day graph. 1 day don't tell me enough information to make a wise decision. I'm gonna start at a minimum of a 3 month. What does a 3 month show me? Well, I can see resistance at the top line at about I'm looking at the closing price. It really hasn't hit past, like 270 was about it. Up in here, it was about the highest it got, was 270. And then I'm gonna look at these low areas here. It was like 2.25, and then down here on the low run, about the same, 2.25. Right. So now, at least from a 3 month graph, I identify a trading zone. It's been as low on average about 2.25 to about a high at 265, 270, support and resistance. So now I have a trading zone. I'm going to also look at the 1 year graph and see what findings I see there. So I see in the 1 year graph that Alibaba has been as high as $300, right? Look like 307, 30, right? So it didn't hit 310. So the market don't really believe this is a $300 stock, but it touched it. It closed up there. And then if you look at the lows, I called out over here 225. So it looked like a little 2, look like 2.25, all the way back to here in June, July of 2020. Closed it. Looked like there was a 215 right there. But basically, high, so anywhere like 215, 220 at the low end, but now it's 240, right? So then I'm gonna go and look at all time and see what kind of trend is Alibaba in. Now, stocks trend 1 of 3 ways. They either go up, they go down, or they stay flat. To me, this looks like an uptrend. It looks like it's an uptrend. And that's how I would probably play it. So if that's the case, I'd hit trade options. We think it's going to go up. So the very first question is, how long? Right? We got to figure out our expiration cycle, because options are a race against time if you buy them. Right? So time is a different factor. It's like playing stock market on steroids. You're up against time. So how long do you think is going to take for Alibaba to make the move you think it's going to make? So we go back to the graph. In the last 5 years, Alibaba's up 225%. In the last year, despite COVID and all that, Alibaba's still up 28% in the last year. If you divide 28% by 12 months, then they're up about 2.5%, maybe. You know what I mean? A little more than 2%, but not quite 3%. In the last 3 months, their stock is down 6%. So it's been averaging down about 2% per month over the last 3 months. The last 1 month, the stock has been down over 11%. However, in the last week, it's come up almost 5%. And in the last day, it's up 1.5%. So the question is, what's your outlook? Because if you notice, this is a game of percentages. If you think that Alibaba is going to make a 10% move, well, that's $24 on top of 240, right? Which puts you at 264. If you think it's going to make a 10% move, that puts you at a 264, which becomes potentially a strike price. So we trade, how long do you think it's going to take? If you want to go at least a month out or better, go look at the April. You can look at April, and you can look at 264 strikes. What's the closest thing to 264? And that's how some people play it. It's not how I play it. I don't like to buy my options out of the money. I like to see what they're worth, and I like to look at the Greeks. So I didn't come out here looking to buy. I came out here looking for the Greeks. So we said a 10% move will put us out here. I click the 265 strike, and I'm going to click the green part that says bid and ask, and I'm looking at the Greeks. I'm looking at everything else too. I'm looking at the volume. I'm looking at the open interest. I'm looking at the applied volatility. Look at the chance of profit. Nothing. It's a 9% chance of profit, so nothing. Look at the delta. I told you the delta was kind of like a rough rule of thumb of what's the percentage of likelihood it expired in the money. This isn't a strong delta. You're pretty much giving away your money playing this deep out of the money. That's why they call it out of the money, because you're probably gonna lose anyway. You buy your calls in the money and you sell them out the money. Now, if I was selling these calls, then yeah, I would sell somebody to 265 because I'd make $100 by April 1st. Because as long as Alibaba don't hit 265, I keep the money. So yeah, if you selling it, that's a great strike. Not so much if you buying it. So if you're buying this, the at the money would be the 240 call. So you'll be paying $625 for one contract. If I hit review, I'm not about to start depositing money, but you're basically paying $625 for the right, but not the obligation to purchase 100 shares of Alibaba for $240 a share on or before April 1st, which we all know is a Friday. So we're going to click the green link for bid and ask so that we can look at the Greeks. So this at the money 240 strike has a delta of 0.50, basically 50-50 chance. It's at the money. You buy a strike that's the same price, the strike price the same price, the market price. All you're paying for is extrinsic value. There is no intrinsic value. If you buy a 240 strike and the price is 240, it's a 50-50 chance of success. Look at the volume. There's a lot of volume out there, some open interest out there, decent, pretty average applied volatility. In this case, they think your chance of profit is less than 50%. So always take away from that delta if you're looking at it, eyeballing it for what's the probability of profitability. I always say I take at least 5% away from it. So I wouldn't look at that delta of 0.5 and say it's a 50-50 chance. I would eyeball and say it's like a 45% chance. Robinhood is telling you 33% chance. So if you want to increase your likelihood of being successful buying a call, you would actually pay more money in premium and go deeper in the money. So like for instance, it tells you percentage of break even. So like right here, if you bought the 230, 250, now this would cost a little bit more. You would pay $1,050 for this contract. But what are you getting? You're getting the right to buy Alibaba for $32.50, and right now it's $240. So you'll be able to buy it $7.50 less than the market price. So it's in the money. If you look at these Greeks, boom, it's less volume because people don't want to pay those higher premiums. It's less open interest. The implied volatility is the same. The chance of profit is way higher. And look at the delta. Basically, the delta is 70. So even if I took away, call it 60, 65, that's still way more likely that it'll finish in the money than the other strike price we're looking at. So you're going to pay more in premium, you're going to get higher delta. If I go back to the 240 instead, right, the delta isn't 69, it's 50. So that's 20 points less. Way more volume, way more open interest. But of course, because look, the contract's cheaper. It's 625 versus 1,050. People tend to gravitate towards the cheaper price. But that's a rookie mistake. If you go out here, some people are like, oh, look at this 250 though. It's only 286 a contract. So they'd be like, why pay 1,050 for that strike price in the money? And I can pay 11, I can pay 885, 858 and get 3 contracts of this. But if you look here, look at the Greeks. Yes, a lot of open interest, a lot of volume there. Same volatility, but look at the chance of profit, 20% chance, and look at the delta, 0.28. Right? Because that's what the 250 call. Same expiration. We still looking at April 1st, but we looking at different strike prices. You see different strike prices have different price of premiums, different Greeks, different likely outcomes of profitability. Right? Some people go way out. Oh, I'm gonna get to 265 because it's only $100. So I'm gonna really come up. I'm gonna spend 1,010. I'm gonna get 10 contracts because you don't know what you're talking about, Billy Blanks. So I'm gonna spend 1,000 instead of buying 1 contract for Alibaba in the money. I'm gonna get 10 contracts out the money for the same $1,000. All right, hot shot. So let's look at the Greeks. It's some volume out there. It's some open interest out there. It's, you know what I mean? It's a lot. It's more volatility. But look at that chance of profit, 9%. So we both put up $1,000. You bought the 265 strike and you got 10 contracts, but you have a 9% chance of being profitable. Delta is 11. And look at how high that theta is. That theta burn, because you are so far out of the money, the time is accelerated against you. You're losing 15 cents a day on each contract. So keep in mind the 265 strike on Alibaba. Look at the delta, look at the theta, look at the chance of profit. Out the money. This is deep out the money. That's the 265. All right. So I'm gonna write it down so I don't forget it because I don't want to have to flip screens either. So 265, we got 418, volume 539, open interest 9% chance of profit. Implied volatility 44% IV, and then we got a delta of a 0.11. That's at the 265 strike. So we're gonna go down. We're gonna go down to the 250. It's out the money, but it ain't deep. It's out the money as the 265. All right. Now the 265 was only what, $100 a contract. The 250 is $286 a contract. So almost cost triple. Look under the Greeks though. Under the hood, you got triple, almost quadruple the volume, 1,509 versus 418. Open interest 5221 versus 539, so 10 times the open interest. Implied volatility dropped from 44% down to 38%. Chance of profit increased significantly from 9% up to 21%. All right. And it has a delta of a 0.28, so almost triple, just by dropping 15 points on the moneyness. Now we go at the money. The at the money strike is 240. at the money. So we looked at deep out the money. We just looked at out the money. Now we're about to look at the money. At the money, same expiration date 4/1. At the money is 6/25 for the contract. All right. Double where we just at 289 for out the money. And 6 times what it was way out the money at 265. But let's look under the hood. Let's look at this now. So we have 1,379 on the volume. So that's healthy volume. 1,397 on open interest. So in line with the same volume is the 250 strike, but but only a third of the open interest as that the out of the money strike. So here at the money, we have a 36% implied volatility, which is down by 2% from the 250 strike. And then our chance of profit has increased by about 5% from 0.2 no, actually it's increased by 12% from 21% chance of profit to 33% chance of profit. And the Greeks has gone up by 0.22 from a 0.28 to a 0.50 at the money, 50-50 chance of success. So now we're going to look at Alibaba in the money. All right, in the money. So we're going to say, let's go, even if it's 5%, 5% of the 240 is going to basically put us about $10 into the money. So let's look at like the 230 strike. Now the 230 strike, the 230 has $10 of intrinsic value, because right now if you look at the top of the screen, Alibaba's 240, you subtract 230 of strike price, that gives you $10 of intrinsic value. But if we're paying $12.30 for the contract, that means that this contract has $2.30 of extrinsic value. So let's look under the hood at these Greeks, see what makes up that $2.30, and then boom, you're going to see quite less volume at 282, because people don't want to pay $1,200 for a contract, and we saw they could have paid 286 or 625 or $100 respectively. All right, so now we looking at 282 on the volume, 773 on the open interest, 36%, 36.5% on the implied volatility, which is up 3% from the other strike. And then look at this chance of profit, 42.5%, which is up from the prior. But the delta, now you got a 0.74. My sweet spot is right there. That's a solid delta, because now you bought Alibaba you have a strike price that is $10 below the current market price. So in order for you to lose money, Alibaba has to drop. It got to drop at least 10 points for you to lose money on this contract. So you pay $2.30 of extrinsic value, right? It was $1,200 out of pocket, $12.30, but keep in mind, $10 of that $12.30 was intrinsic value. $1,000 of this was intrinsic value. You only paid $230 of extrinsic. If you come here and pay for the 240 strike, this is the same strike as the market. This is 625. So all that 625 is extrinsic value, because you have no intrinsic value. It's not in the money. The strike price and the stock price are the same price. So you paying 625 for nothing in this situation for one contract. Or you can pay double the strike. I mean, you can pay double the premium and pay $12.30, but have the peace of mind knowing $10 out of that, you know what I mean? Out of that $12.30 went to intrinsic value. So this would actually be way smarter, but this would be way better to buy if you was trying to buy a car. You would buy something like this. Did I lose anybody? Any questions? And how we looked up and down the options chain, probability, use Alibaba, strike price, market price, Greeks, delta, implied volatility, open interest, chance of profit. We covered quite a bit. Just want to make sure y'all are with me.
You're still here. That was a lot.
I get in the zone at times, forgive me. In the zone. No, seriously, are there any questions? Get ready to wrap up shortly. Just wanted to make sure there are no questions. Yes, no, maybe so. All right, so these are called profit and loss diagrams. You'll see this a lot in your journey of looking at options, and this is basically a visual representation with a simple X and Y axis of price. Of profit and loss versus price. And so these are three of the most popular options strategies, if you will. One being a long call, right? So that was something we were looking at just a moment ago, right? We were buying a call and we were looking up and down the options chain to figure out which strike price made the most sense for us, because they all have different break evens, right? They all have different break evens. They all have different benefits and pros and cons, whether it's how much you come out of pocket up front, whether it's, if we looked at different expiration dates, we'll be looking at how much the extra time would have cost us. We probably do that as well. But just looking at and seeing at different strike price and one expiration, how the price of the premium changed. Protective put, we'll look at that as well. That's basically you're paying money to make sure you can sell your stock to somebody else at a higher strike price, so you don't lose. It's like an insurance policy. All right, and then you have the buy right, which is the covered call strategy, which is one of my most popular strategies, where you own at least 100 shares of underlying asset and then you sell stock against it and collect the premium. So we'll make sure that you guys have this. This is the last little bit of the lesson for today. Let me go ahead and put this back over here. Actually, I know what I'm gonna do. Going to keep it going with this profit and loss diagram. Give me 1 second.
The profit and loss of an option position at expiration is a function of the original premium and the difference in price between the futures contract and the strike price of the option. Let's suppose you sell the 105 call for $2 in premium. The maximum profit potential for this trade is $2. Let's look at a few different possibility outcomes for the futures price at 112, 106, 100, and 94. To understand the profit and loss, let's look at the math for each of these potential scenarios. You sold the option and collected $2 in premium. For each scenario, the premium column will be $2, and the strike price is 105. This is the price at which you are obligated to sell the futures contract if you are assigned. In scenario number 1, the futures price at option expiry is 112. This option will be in the money and you would be assigned. You will sell the future for 105, creating an instantaneous $7 loss on the future. You collected $2 in premium and lost $7 on the future, so your net loss will be $5. For scenario 2, we see the futures price at option expiry is 106. This option is also in the money, and again, you would be assigned. You will sell the future at the strike price of 105 and have a loss of 1 on the future. The net will be a profit of 1. In scenario number 3, the futures price at option expiry is 100. This option is out of the money and will not be exercised. There will be no loss from futures. Therefore, your $2 collected in premium will become your total profit. Scenario 4 has the futures price at 94. This example is like scenario 3. The option will be out of the money and will not be exercised. Again, your final net position will be a profit of $2. Now let's look at the same group of scenarios, but from the buyer's perspective. In this case, you buy a call at 105 and pay $2 premium to the seller. Let's look at your profit and loss potential using the same futures prices at option expiration. In scenario 1, the futures price at option expiration will be 112. This option is in the money. You exercise the option at 105. With the futures at 112, this will result in a gain of 7. If you subtract the $2 premium paid for the option, your net profit will be $5. For scenario 2, the futures price at option expiration will be 106. Again, this option is still in the money. You exercise this option at 105 and make $1. You paid $2 in premium, so your net will be a loss of $1. Scenarios 3 and 4 are both out of the money options. In both cases, you would not exercise the option. Your net loss has been capped at $2, which is the full premium paid for the option. There you have it. 2 views of profit and loss from either side of the same transaction. When looking at profit and loss potential of an option position at expiration, you will need to consider the original premium and the difference in price between the futures contract and the strike price of the option.
All right. Let me get to some more real life examples. Any questions so far? Please, you guys have been pretty quiet. Anything you want to put in the chat? Any questions you want to unmute your mic and ask? Please do. We're going to go ahead and go into the Q&A.
The profit and loss.
We're going to the Q&A piece.
In that, it was that graphic you put up just before the video. It had something about right something. What was that third column? I didn't really get that. That went by kind of quickly.
Okay. Let me put that back up. Hold on. Give me one moment to switch back to that particular slide. All right, so I should have my screen. So let me see. Let me go back. All right, so now I want us to trip. Hold on a second. All right, so for whatever reason, it's not okay. There we go. To get to the keynote. So that's a great question. So let me know if you can see the screen now. I was trying to bring it back up. You should see.
Yeah. Yeah, the buy right.
All right, so I'll show that in the Robinhood real quick as well. So the buy right. So these 3 things. One, long call is you buy a call, right? You pay money, a premium. You buy a call because you're bullish. You think that the underlying is going to go up, and all you're going to do, the game plan with that is to flip it to somebody else for a higher profit. You know what I mean? A higher price than you paid for it. Or if you want to, you can exercise and you can come up with the big bag of cash and cash out on all the shares. Just know that you're responsible for 100 shares per contract. Protective put, you own 100 shares of stock, and in case the price goes down, you want to protect your downside. So you pay money to somebody to take on your risk. That's when you pay out. You pay out in the long call, you pay to buy the underlying, and in the protective put, you paying to sell. In both of those scenarios, you're paying, you're the buyer. In the third one, you're the seller. The buy right is you buy stock. You bought the 100 shares, and now you write. Writing is called selling. If you write an option, you are selling it. You are writing up the contract. You're saying, well, look, I got 100 shares of this stock, and I'm willing to let them go at this amount on or before this specific date. And I need X amount of dollars in premium to feel satisfied to do that, to take on that obligation. Okay. So what I'll do real quick to wrap up today is I'll show an example of the other 2. I just showed the long call with Alibaba, right? I showed y'all and we look up and down the chain at several different strike prices to buy a long call in Alibaba, because we think Alibaba is going to go up, right? So let's look at the last two things in here. So it's a protective put and it's the buy right. So we go into here. I'm going to look and see. Let me find us a company that I have 100 shares of. So under stocks, let's go to Rocket. All right. I hit trade options. And let's say I want to buy protection because I think it's going to go down. I want to cover myself, let's say all the way to middle of June. All right. I want to cover myself to the middle of June. Then I could buy a put because I own 200 shares. Right now, the price is $23.21. I'm nervous. I think that it's going to go down. So I'm going to buy a put just in case. Well, I can say if it goes down to $21.89, cash me out. And I need coverage for 2 contracts. That means I would pay out $690, but you can always put your limit price. You don't have to go with the mark. I can say 3.25. I'll pay $650 for mine. And it may or may not transact there, right? I may have to wait a little bit for it to hit that number, but that's a limit price. And I would pay $650 for those 2 contracts. I go ahead and look at the Greeks, right? It's the opposite. So I got a negative delta, right? You look at the gamma, you got your theta, your vega, you got your rho. You see it's not a lot of volume. There's a ton of open interest, a lot of implied volatility. It's a 40% chance of profit. All right. So I'm buying. What am I buying? I'm buying the right, but not the obligation to sell 200 shares of RKT Rocket Companies to somebody else on or before June 18th at $21.89 a share. Right now, it's $23.21. So I'm paying $650 to cover these 200 shares to make sure it don't bottom out. Right. So if it go down to 15, I won't be caught in the mix, 10 or 15, because I'm gonna get cashed out at $21.89. But I gotta pay $650 up front for that. And if it never falls that low, then I'm gonna lose the whole $650. But if the stock starts tanking, I'll make money off the $650 if it starts tanking, because I have a contract that puts me whole at a higher number.
Okay, yep, that works. That's clarification.
There we go. I like that. I like that. Who else has questions? Any from the chats? Anything from the Facebook or anything like that?
No, we've had people kind of coming and going, so no one has put any questions in the chat yet.
No problem.
Mm-hmm.
No problem at all. Well, I am game for any questions that may arise. I believe that it's defaulted back to you for the host at this point, and that's all the stuff I had. So I'm just here at this moment really for Q&A.
Yep, and if no one has any, let me see, that's fine. We have one more session on stock options, and really grateful that you're here. And I know it's very new to everyone, so that could be, it's just like trying to wrap our minds around it. But we will have this recording available on our Facebook page, and we just started a YouTube, so we can put it over there also. So you can kind of watch it over and over again to help you refresh. And did you want to give your Ken? I don't think you have put this time. You didn't put like your website or anything where they can go for other information or opportunities to learn about the stock market.
Yeah, I can give me one moment and I will share a link. I will share a link for everybody. I have a link tree. I think it's HTTP. It's S link. I don't know if this is correct though. Let me see. We're gonna try it. We're gonna try it out. We're gonna see if this works. I'm trying to go off of memory while I'm waiting on the
Okay, well, I clicked it. Let's see if it works. Yep, that's right.
it
And
works.
yeah.
All right, sweet. So that's it. Yes.
Okay, and we'll also put this on our as a comment on the Facebook video, so people will have it there. All right. Well, thank you so much for coming. I don't want to hold you, to the bitter end. We're at the end of our time.
Appreciate you.
Yeah, I think this is one of our first, sunny days. Is it the first day of spring?
Yeah, you bringing it in. You got the sunshine beaming in on you.
That's a bit too much, but I think people are, probably out and about or excited in Michigan, at least, that it's finally, getting to spring. So, but that's why one great thing about having the virtual programs is that it's available on demand. So I'm sure we'll probably get more views later. And we thank you so much for coming. And we look forward to, we got, do you remember the date on the next one? What is it? Is it April 20th?
I believe it is.
4 weeks on Saturday,
Yep.
again at 1 p.m. So thanks everybody for coming. We're going to end the program now, and take care, and I wish you well in your financial endeavors. All right.
Yes.
Take care.